This is Dr. Paz, and welcome to our Auditing Chapter 2 Professional Standards lecture. If you'll see right here, we're going to be discussing Bernie Madoff, and he is actually the case that we have for this learning module. And you'll see that he actually embezzled $50 billion from investors in what has been known as our classic Ponzi scheme. So let's go over what you're going to learn. We are going to discuss Generally Accepted Auditing Standards, GAAS, Generally Accepted Auditing Standards. We're also going to discuss the fundamental principles of responsibilities and how they apply to the characteristics and the qualifications that auditors must have. We're also going to talk about the fundamental principle of performance in the activities that we have to perform during an audit. And lastly, we're going to talk about the fundamental principles of reporting, which is the contents of our auditor's report, which is basically the opinions that we give not only on internal controls, but also on our financial statements. And lastly, we're going to discuss the role of quality control and monitoring as they relate to our professional quality and the appropriate level that we need to have as auditors. So let's dive right in, and let's start with a little bit of history of our professional standard settings. In this course, we will talk about the PCAOB, the Public Company Accounting Oversight Board. And that is pretty much our regulatory bodies from 2003 to current. Keep in mind that in 2002 we had a little issue known as Enron, and then we had Sarbanes-Oxley. You can also refer to the statements of auditing standards from the AICPA, the American Institute of Certified Public Accountants. So these are the two types of professional standards that you will be kind of citing in your cases and also just referring to as you learn auditing. So the auditing standards that we're looking at, as I mentioned, were the PCAOB standards and the AICPA statements of auditing standards. Note that our PCAOB standards, those are the ones that pretty much deal with the audit of public entities. They don't really deal with non-public entities. So right here is where we're in the external audit phase. So anytime we're talking about external audit, you're going to be in the PCAOB realm, and if you're talking about non-public or sometimes internal auditing, then the AICPA will be relevant. So let's go over GAAS, Generally Accepted Accounting Principles, and here are the three main fundamental principles that we have that we covered within our learning objectives: responsibilities, performance, and reporting. And then lastly, we're going to talk about the quality of public accounting firms. So GAAS pretty much tells us the qualifications and the characteristics that really guide the auditor in how they conduct their audit. Now, the purpose of generally accepted auditing standards is basically we're trying to find reasonable assurance that the financial statements are free of material misstatement. This is a critical piece here. So you want to make sure you remember that. Audits provide reasonable assurance that the financial statements are free of material misstatement. We're not saying that they're free from error, and we are not saying that they are free from fraud. All we're saying is that in an audit is that they are free of material misstatement. So the report on the financial statements basically is communicated in what the auditor finds, and that report is our audit opinion. And note, we have two opinions. We have an opinion on the financial statement, and we have an opinion on the internal controls. And those opinions are what's known as our integrated audit, which basically means we audit both facets now, financial statements and internal controls. So now let's talk about just the entire pronouncements, right? So here we have GAAS, and then here we have the three fundamental principles that we just went over: reporting and performance and responsibilities. Then we have our PCAOB, which pretty much gives us the requirements to support these principles. And then lastly, we have interpretive publications. This is where we focus with the PCAOB and the fundamental principles, because remember, this is kind of going both ways, right? So our PCAOB is what's kind of detailing what we have to do and what's required for the fundamental principles. So we have then the 10 basic standards. This is heavily tested on the CPA exam, the audit section. So you want to make sure that you pay extra special attention. So we have general standards that we have to have training and proficiency. Auditors have to be independent and they have to have due professional care. So basically what that's telling us as auditors is we have to be competent, we have to know what we're doing. There are some ethical requirements of independence and that due care that we're actually saying what we're doing. And the key point here is professional skepticism and professional judgment. So here you have to have an inquisitive mind and you have to question what doesn't make sense. Then we have standards of field work. So when we're actually out at the client location conducting our audit should be planned and supervised, right? We need to gain an understanding of the entity and we have to assess risk for material misstatement. The higher the risk, the more you have to audit, right? So if the risk is lower, then our field work would be less and maybe the amount of evidence that we need to get is less. And you'll note that we need to have evidence that is sufficient and appropriate. Again, a very important concept. Sufficient and appropriate is our evidence, and the ending result is our audit report, which we now know is our audit opinion. So that's where we're heading. And lastly, let's talk about these statements, the standards of reporting, right? So here we're saying that in our audit opinion that the financial statements were prepared according to GAAP and that GAAP is applied consistently, so there isn't a departure of GAAP. And also we're saying that we have the proper disclosures, which is really the footnotes or the notes to the financial statements. And then we have to express or disclaim an opinion, and there are several types of opinion. The unqualified opinion is hopefully the most common, which is basically the clean opinion, which tells you that the financial statements are free of material misstatement, right? So they are not free of error and they are not free of fraud, but they are free of material misstatement. So the reporting principle states that as an auditor, we're going to express an opinion or we're going to say we don't have sufficient evidence or our scope has been limited and we cannot express an opinion. And when we do express an opinion, we say that the financial statements are pretty much applicable to, in this case, GAAP, right? That they're following GAAP. So we have several stages of the audit, and here we have to find a client, right? Then we have to plan the engagement, and here's where our engagement letter comes in. We have to assess risk, we have to gain evidence, which has to be sufficient and appropriate, as we mentioned, to give us the opinion, and then we report, which is basically our audit opinion. So then we have the responsibilities, which we have to be competent and independent, right? And then we have to have professional skepticism and we have to exercise professional judgment and we have to have due care, which means that we're actually going to perform the audit, and that's where our performance comes in. And then our reporting is that of the opinion, and we know that we issue an opinion on the financial statements and the internal controls now. So those are all the stages of an audit. So let's talk about responsibilities now. So here we are where we're trying to obtain our engagement. And here what we need to do is we need to have competent auditors that have the proper experience. We need to be independent. Most of the audit issues are because there is an independence in fact or appearance, right? So we can't have financial and managerial relationships with our client. We can't own large or majority of stock. We have to, as auditors, have to have due care where we are performing what a reasonable auditor would perform in a certain circumstance, right? So we're doing the same actions that another auditor would do. And then we have to have skepticism, which is our questioning of our evidence, and we have to have judgment, which is basically our application. So this is where our critical thinking comes in of what we know in our experience and what the evidence is telling us as we are applying these informed decisions throughout our field work, which eventually will be our audit. So now let's talk about performance. So we're moving to the engagement planning stage, and here the goal is to provide reasonable assurance that the financial statements do not contain material misstatements. So here what's required is we need to plan. The audit plan is one of the most important phases of the audit, and students tend to gloss over that. Before you accept a client, then you need to make sure that you're planning the audit properly, that you have the auditors in place to do so. You also have to set your threshold for materiality. Now, materiality is basically what would influence financial statement users. So what amount you're going to set. So this is a dollar amount, that if an amount is above this threshold, it would be material and it would change the decision of a financial statement user. And that materiality stays with us throughout the entire audit, and we pretty much hold any adjustments to that level. Then we want to assess risk, and we're going to talk about our audit risk. We're going to talk about our control risk, our inherent risk. So this will all come later. And here we're understanding the business itself, the entity, and we're understanding the internal controls. And then we want to determine what type of substantive testing we're going to do, right? We have analytical procedures as one type of test. Then we have substantive test of details. And we have test of account balances. So those are the major types of tests that we do when we're out in the field. And as I mentioned before, audit evidence needs to be sufficient in amount and appropriate in quality. So this is the level of reliability that we need. And obviously from the source, third-party sources are higher quality, right? If we're getting something from the client that they produce, that's lower quality. But if we're getting a bank confirmation that's coming from the financial institution directly to the auditors, that's of a higher quality source. So now let's talk about risk assessment. And when we're talking about risk, we're talking about our effectiveness of internal controls. And then if we have a lower risk, then we would have to use less substantiative procedures, which is our testing. Now, if we have a higher risk, then we're going to have to increase that type of testing. Now, audit evidence, which is our fourth stage in our audit and one of the most critical stages, right? So we have detection risk, which is basically if we're going to detect a material misstatement or not. Then we need to discuss the appropriateness and the sufficiency. So we have quality and quantity here. And basically, when we're talking about appropriateness, we want to see if it's relevant and reliable. And where have you seen relevant and reliable before? In our statement of financial accounting concepts. So the SFAC, I believe it's number 2. Relevance and reliability are qualitative characteristics that are part of our conceptual framework, which is now also coming into auditing as well. So when we're talking about quality, as I mentioned, we have relevance and reliability, which is our statement of financial accounting concepts. And here we have the reliability, the auditor's direct knowledge, and then the external and internal evidence that we obtain. If there's external, this is higher in our reliability, and if it's internal, it's lower. So sufficiency of evidence, here we're just talking about how much, right? And so when we talk about how much coverage comes into our discussion, how much, what percentage of the account balance are we sampling? And what determines how much or how little is the effectiveness of the internal controls. So if we can rely on the internal controls, then we don't have to do as much testing. If we cannot rely, then we would have to do alternative procedures and continue and increase our sample for our substantive testing. And lastly, our last fundamental principle is reporting. And when we talk about reporting, there is our 5th stage of our audit. And when we're talking about reporting is basically the end result of our audit is the opinion, right? And whether we are going to express an opinion or we are going to disclaim the opinion and not express it, And we're just basically assessing the financial statement and the financial reporting framework. And so here, what we're using is some type of measurement, recognition, presentation, disclosure of material items in the financial statements. And so examples here, if we're following GAAP or IFRS or another framework. Mostly in the US, obviously we follow GAAP. And so we still haven't converged GAAP and IFRS, but at this point, our reporting principle is we're expressing an opinion. And so this is what our opinion looks like. And so here we have the introductory paragraph, which tells us that we've audited the financial statements. Here we're talking about a balance sheet and the related income statement, stockholders' equity statements, and the statement of cash flows for 3 years, which is very typical of SEC requirements. And then we're saying that the auditors are responsible to express an opinion. Then the scope paragraph tells us what the auditors did. So here we conducted our audit in accordance to the PCAOB, and those standards require us to plan and perform the audit, which is our early stages. And we want to obtain reasonable assurance about whether the financial statements are free of material misstatement. Notice the importance of that. We are obtaining reasonable assurance about whether the financial statements are free of material misstatement. Then we describe what an audit is, which is basically we're examining on a test basis or through sampling supporting amounts and disclosures. Keep in mind the financial statements must have the notes, the footnotes, in order to be a complete set. Both these two items, the financial statements itself plus the footnote disclosures, all the notes to the financials. So, and then we're saying the audit includes assessment of the accounting principles, which include any estimates that were made by management, as well as as auditors are evaluating the financial statement presentation. And the audits provide a reasonable basis for our opinion. Then we move on to the opinion paragraph, which is basically saying that they present fairly in all material respects the financial position of McDonald's in this case. So this is an unqualified opinion. And then we have, so right here is our opinion of the financial statement. So all of these paragraphs are on the financial statements, and then here we have an internal control. Now you can issue two separate opinions, or in this case you can consolidate them into one opinion. And then the internal control paragraph is basically again referring to the PCAOB here, and we're saying that the internal controls over financial reporting, which is what we're concerned with, the internal controls over financial reporting were established according to COSO, the Committee of Sponsoring Organizations, so COSO, which is of the Treadwell Commission, and they express an unqualified opinion. So in this case, McDonald's has two unqualified opinions, one on the financial statements, which is the first 3 paragraphs, the introductory scope and opinion, and then the second is the internal control paragraph. And so this is the clean opinion, and this is the opinion that we all want. Here we see that Ernst & Young is the auditors, and this date at the very bottom is the last date of field work. So that is the last date of field work. So that's the last date that the auditors pulled out, went back to the office to compile the reports. So we went through. There are other items in the auditor's report. So we have that the auditor is stating that it's management's responsibility for financial reporting. So management is responsible, and management are the ones that make the assertions such as completeness and accuracy and valuation. That the audit is conducted with PCAOB standards, the Public Company Accounting Oversight Board, and we have our opinion on the financial statements, and we have our opinion on the internal controls. And they can be 2 separate opinions, or as we saw previously with McDonald's, we have it in one opinion with several paragraphs. So we just... So now we have the unqualified, which is the opinion that we want, which is what we saw with McDonald's. So that's everything is according to GAAP, so that's A-okay. Then we have our second opinion, which is a qualified opinion. And so this is what we know as an except for. So everything in the financial statements is according to GAAP and as it should be, except for one item.
I'm sure I understand.
Except for one item. And that one item is usually detailed in a paragraph. Then we have an adverse opinion, which is basically you're not in conformity with GAAP, which is very detrimental. And then when we cannot express an opinion, this is your disclaimer. And the disclaimer usually comes because your scope was limited. So for example, if the client doesn't give you certain transactions and you as an auditor feel that these transactions could be an issue, then you would possibly give a disclaimer. And then we have here that the unmodified is used for non-public companies while the unqualified is used for public companies. So you'll see we will normally refer to it as an unqualified opinion. So when you're evaluating the quality, this is, now we've gone through all the principles, so this is our last objective. Right now we're going to look at the quality of public accounting firms. And there's a control system that's in place to also provide reasonable assurance that the actual auditing firm has some assurance and has some personnel that are competent and independent. So here the whole quality control process is to make sure that the auditing firm is kind of checking the dots, that they're following the professional standards and they're following all the regulatory and the legal requirements, and that they're issuing the correct report within the correct circumstances. So all the audit evidence is sufficient and appropriate to support the opinion that the auditors gave. So there are elements of this quality control system, right? So we always at the top, right? The tone at the top, the leadership for the firm, what ethical requirements the firm has, what acceptance and continuous policies of the clients the firm has, what about their HR department, how their engagements are performed, and then there's a monitoring, a peer review process. So the PCAOB says that monitoring public accounting firms is done through inspections, and if your firms audit greater than 100 public entities, it's done annually. If you're doing less, it's every 3 years. So most of the big four are doing over 100 public entities, so they would be about annually. And what's interesting is if you go to this link, you'll see the inspection reports and the deficiencies that are noted in the audit. And all of the big four have some type of deficiency in the inspection report.